Bobby Monks, in your book, Uninvested, you say that our money managers are systematically fleecing us. So how are they stealing our money?
Well, I think the big issue that we're trying to shine some light on is the fact that the average investor, we believe, as you said, is being systematically taken advantage of by the financial services industry. And by average investor, we mean anyone who has a 401k, anyone who has a retirement account, or anyone who has a mutual fund. Now, we're not saying that all money managers are boogeymen, but what we are saying is that the system is broken. Almost 90% of the financial advisors don't have to put the interest of the client first. The fees are often high, they're often undisclosed, and they're often layered. And then it's the only business I know where you get paid whether you make somebody money or not. And so what we do in the book is that we try to demystify the system for the average investor so that they understand it a little bit better. And then we offer them some guidance in terms of how they can regain control over their investments.
Now, most individual investors have their money in mutual funds, and this is supposed to be the safest, most transparent way. You can see your holdings in a mutual fund. So can you tell me what's wrong with mutual funds specifically?
Well, I'd say, first of all, they're extremely complex. They're supposed to be very simple instruments, and I don't know if you've ever read a prospectus for a mutual fund, but I wouldn't recommend it. They're supposed to be written in quote, plain English, and often they obscure in very difficult language to read what the fees are, what the conflicts of interest are. I think there are certainly very high fees that are associated with mutual funds. They're a little bit better about reporting them now, but they still don't report a lot of the trading costs. And as you probably know, there's a 60% turnover rate in mutual funds, an average of 60%. And then people actually, a lot of the times don't know what they're invested in because it's not always publicized what their actual stocks that they are invested in. And finally, there is a separation between the investor and the right to vote their proxy, and we don't think that's a good thing.
What about index funds and ETFs? Because those are a big deal right now. More and more people are pulling their money out of actively managed funds and into the index funds.
Well, I think I give Jack Bogle a great deal of credit for what he's done with the index funds. I think he has lowered fees a tremendous amount, and I think that's a good thing. But not all index funds are made the same. There are index funds that have higher fees. We don't always know what the trading costs are. They're not always disclosed. And a lot of the times we don't know what's actually in the index fund. They're so big and they're so vast, we have no idea what stock we're invested in. And some investors could be invested in stocks that they don't agree with companies that do things that they don't like. And then finally, I think, index funds are in the market more than anything else, and therefore they should be the ones that are most responsible about their corporate governance and in terms of voting the proxies. And I think it's almost 75% of index funds vote for management.
All right, so give me the better way. What's the best way for investors to safely invest and not get systematically fleeced?
Well, I think what we're advocating is that the average investor become engaged with their money manager. So they go to their money manager and they ask a series of questions. Let me give you an example. Do you have to put my interest first? What are my total fees, including trading costs? And do you invest in the same stocks that you're, or mutual funds or index funds that you're putting me in?
And do you want your money manager to invest in the same places that he's in? Is that a positive thing? And also, around what should people be paying? And should they ask around to see if they're paying too much?
Well, I'm not recommending, it really depends on the individual person about what they should pay, but what they ought to do is, again, engage with their money manager, make sure that they know. They should ask the question and then make sure they understand the answer to that question, and then if they don't like what they're getting, they should go next door and talk with somebody else.
Well, because there are different levels of service. People have bigger portfolios, different needs, right?
There's no doubt about it, and what we're recommending is that the average investor engage in the process.
Well, that's definitely a good idea, and thanks for coming on and talking about Uninvested.
Thank you very much. Nice to meet you.
And thank you for watching The Street.